Gold is sitting right on top of a major liquidity minefield. And right now, smart money is prepping their next massive, aggressive move. In today's explainer, we're targeting a massive sell setup, resting just above key liquidity. But there is exactly one institutional condition that has to trigger first before we even think about executing. Here's the problem. Most retail traders, they are looking at the exact wrong level today. They're obsessed with traditional support and resistance, totally blind to the engineered liquidity pools building up behind the scenes. So we're going to expose exactly where institutions are actually aiming, what gold is highly likely to do next, and where the true high-probability opportunity is hiding for the New York session.
All right, let's get right into the higher time frame bias. Looking at the daily chart, our macro directional bias is aggressively bearish. We've completely smashed through that major structural swing low near 4112. What you're seeing right now, this deep premium pullback, it's not a reversal, it's a targeted short covering pump. The algorithms are just driving price up into bearish institutional arrays to rebalance before ripping it back down.
Dropping down to the 4-hour, the dominant structure is crystal clear. Lower highs, lower lows. That sharp upward move we just saw, that was a deliberate surgical liquidity run. Smart money drove the price up for one specific reason: to mitigate premium imbalances. We're talking about fair value gaps and order blocks sitting heavily in that 4330 to 4365 region. Price tapped right into that massive bearish imbalance and violently rejected it. Heavy institutional supply is absolutely defending that zone.
Now, inside the 1-hour dealing range, the primary liquidity targets are exposed. We are heavily positioned for a bearish continuation. Sitting just above us are internal buy-side liquidity traps. These are those minor highs engineered to look like safe breakouts. But the true ultimate magnetic draw, the real target, that is the external sell-side liquidity resting all the way down at 4223. That is exactly where the algorithm wants to drag this market.
But to get all the way down there, the market needs a spark. Algorithms require massive volatility injections to sweep liquidity and displace price. Just look at the fundamental catalysts we have. The Fed held rates at 3.5 to 3.75%, but delivered a very hawkish pivot, signaling inflation is still a pressing concern. On the geopolitical side, the US and Iran just signed a memorandum of understanding in Geneva, which instantly cooled safe haven demand for gold. Add to that the dollar index dropping from an 11-week high. Listen, these aren't just news headlines. These are the exact algorithmic triggers institutions use to engineer volume spikes.
And the timing for all this volatility? It's precision engineered. We've got high-impact USD data, the Philly Fed Manufacturing Index, and unemployment claims, dropping exactly at 7:30 p.m. Institutions are going to use this specific New York session news window to unleash a violent stop hunt. Expect a rapid, vicious manipulation to sweep out early retail positions right before the true, aggressive displacement toward those lower targets kicks in. Which brings us to a crucial smart money concept: inducement. Think of an inducement as a deliberate algorithmic trap. It's price manipulation designed solely to trick retail traders into entering early. You see those minor resistance levels hovering just above current price? Pure inducements. They are literally placed there to tempt breakout traders into buying, which creates the exact buy-side liquidity that smart money desperately needs to pair off their massive short orders.
So how do we actually trade this objectively? Our primary, highest probability plan is the bearish continuation. We want to sell from that premium retest zone, keeping an invalidation stop safely tucked above the structural recovery high. We'll take partial profits on the way down, leaving a runner for that ultimate 4225 target. That gives us a beautiful 1 to 3.5 risk-to-reward ratio. What about buying? Well, a buy scenario only becomes valid if the market first engineers a massive, heavy raid to sweep sell-side liquidity before the news, followed by a violent reclaim. But right now, the vast majority of the probability is riding on that macro bearish delivery. Now, dropping into the 15-minute time frame for our execution model. Let me be perfectly clear about this. Right now, there is zero trade we sit on our hands. The strict execution rule here is we must see a clean 15-minute market structure shift. We need a sharp, bearish displacement candle that breaks a minor swing low and leaves behind a fresh fair value gap. That is your definitive smart money footprint. Until you see that exact footprint, patience is your only play. And here is the exact scenario most traders are completely ignoring. Let's contrast what retail sees versus the institutional reality. Our retail trader sees the price pushing up and immediately thinks, oh, it's a breakout, momentum is bullish, I've got to buy right now. But the institutional algorithm,
It sees that exact same move and calculates, perfect, buy-side liquidity is activated. Time to unload our short orders.
This right here is exactly where smart money creates the trap. If the price spikes up into that 43.25 or 43.30 region right before the 7:30 p.m. data release, breakout traders are going to get aggressively trapped going long. The market is literally sending a warning signal right now by hovering near equilibrium. The algorithms are baiting the hook, just waiting for retail to bite.
Now, you might be wondering what completely destroys our bearish narrative. The magic number is 43.45. A sustained daily close above 43.45, backed by heavy buy-side displacement, is our hard and validation point. If that happens, the entire institutional narrative flips. It proves this recent drop was actually just an accumulation phase. If 43.45 breaks, our short bias is entirely canceled. Scratch that plan.
Let's quickly lock in the core institutional action plan from this explainer. Right now, our positioning is flat. We are waiting for the New York kill zone and that news catalyst. The objective? Watch the algorithm sweep that internal buy-side liquidity, wait for that mandatory 15-minute bearish displacement trigger, and then aim straight for 42.23. And please, listen to me, strict risk management is non-negotiable. Do not risk more than 0.5% to 1% of your account equity on a single setup.
If you enjoy this kind of deep, institutional-level market analysis using ICT and smart money concepts, you'll definitely want to subscribe to ICT Market Theory for further insights. And hey, if you want to actually execute these specific setups alongside this analysis, you can find the FXTM account link down in the pinned comment.
So I'll leave you with this final question as we head into the New York session. Are you going to let the algorithms hunt your stop today because you jumped in too early? Or will you exercise the iron discipline needed to patiently wait for the definitive smart money footprint? The market rewards patience and it absolutely punishes impulse. Wait for the confirmation and trade the institutional reality.